Stop. Right now. Pause what you're doing. You just watched a video that showed you how 4 men across 3 centuries built a debt trap that enslaves every government on Earth. 38 trillion in US debt. 315 trillion globally. A system designed so you can never escape. But here's what that video didn't tell you. The architects of the debt trap left back doors. Not for you. Not for me. For themselves. For the people who understand how the machine actually works, while everyone else drowns in inflation, while your salary buys less every year, while your savings evaporate. There are 4 specific moves that let you walk through the walls of the prison. Everyone else is trapped inside. I'm going to show you all 4. Right now, in the next 15 minutes. But I need you to understand something first. The system depends on you not knowing these escape routes. It depends on you keeping your money in cash. In banks, in the places where inflation destroys it silently while interest payments flow upward to the people who designed the trap. So if you want to escape, actually escape, not just understand the problem, you need to watch every second of this video. Because by the end, you'll know exactly how to protect your money. Build inflation-proof income, avoid the banking collapse that's coming, and break free from the lifestyle trap that keeps pulling people back into debt. Let's start with the truth they won't tell you. Here's what's happening right now, today, while you're watching this. The United States government owes $38 trillion. Japan owes $9 trillion. Europe owes $14 trillion. The entire planet owes $315 trillion. 3 times the size of the global economy. And remember what you learned. This debt can never be repaid. It's designed to be permanent. The interest flows forever, from taxpayers to bondholders, from workers to capital, from you to them. Now here's why this isn't just some abstract economic problem. Every dollar of that debt gets paid through your life. When governments borrow more, they print more money. That's inflation. Your salary stays the same, but groceries cost more. Rent costs more, gas costs more, everything costs more. When they can't print anymore, they raise taxes. More money out of your paycheck, more money on every purchase, more money on your property. You're not just living in the debt trap. You're paying for it every single day. Your salary, eroded by inflation. Your savings, losing 3 to 7% purchasing power per year. Your retirement, being devalued in real time. Your cost of living, rising faster than your income ever will. You cannot stop the system. The debt trap is global. It's structural. It's been built over 330 years, and it's not going to collapse because you vote differently or complain online. But here's what you can do. You can stop the system from crushing you. You can use the same escape routes the wealthy use. The same moves the people who designed this trap use to protect themselves while everyone else suffers. There are 4 strategies. 4 specific moves. And if you implement even 2 of them, you will be more protected than 95% of people when the next crisis hits. Let's start with the most important one, the one that's draining your wealth right now, today, as we speak. Cash is the first victim of debt. Here's what's happening to your money right now. You work, you get paid. You save some money in your bank account. You think you're being responsible? And every single year, that money loses value. Not because you spent it, because the government needs to service $38 trillion in debt. So the Federal Reserve creates new money to buy government bonds. More dollars enter the system. Each existing dollar is worth less. This is called inflation, and it's not a bug. It's a feature. Show graph. Dollar purchasing power declining over time. The dollar has lost 97% of its purchasing power since 1913, the year J.P. Morgan's Federal Reserve was created. That's not an accident. That's the debt trap, working exactly as designed. But here's what the wealthy know that you don't. The poor hold cash. The wealthy hold assets. Because cash guarantees you lose, but assets protect you. Let me show you exactly how this works. Move number 1. Convert cash into anti-inflation stores of value. If you have money sitting in a regular savings account, earning 0.5% interest, while inflation is 3 to 7%, you're losing money every single day. Here's what you do instead. Option 1. Treasury inflation-protected securities tips. These are government bonds that adjust with inflation. When inflation goes up, your principal goes up. You're protected. The government literally has to pay you more when they devalue the currency. You can buy these directly through treasurydirect.gov. No broker needed. Option 2. Physical gold and silver, 5 to 10% of your portfolio. For 5,000 years, gold has been money. When paper currencies collapse, gold doesn't. It's insurance against the debt trap. You don't need to go out, just 5 to 10% of your savings in physical precious metals, not paper gold, not ETFs, actual metal you can hold. Option 3. Productive assets. This means stocks, real estate, businesses, things that generate value and rise with inflation. When the money supply expands, asset prices rise. If you own the assets, you benefit. If you only hold cash, you lose. Simple index funds like VOO, Vanguard S&P 500, or VTI, Total Stock Market, let you own a piece of productive America. As inflation happens, these companies raise prices. Your shares rise with them. Option 4. High-yield savings for liquidity only. Some online banks offer 4 to 5% interest right now. This doesn't beat inflation long-term, but at S, where you keep your emergency fund, minus 3 to 6 months of expenses that you might need access to quickly. Use Ally, Marcus, or American Express savings accounts. Not for wealth building, just for liquidity. Move number 2. Keep short-term flexibility. Don't lock everything into long-term investments you can't access. Life happens, emergencies happen. You need liquid money. The strategy: emergency fund, 3 to 6 months expenses in high-yield savings. Everything else, split between inflation-protected assets. This way you're not forced to sell investments at a loss when you need cash. Here's the main point. Every year you keep significant money in cash. You're volunteering to pay the inflation tax. You're letting the debt trap drain your wealth silently. The escape is simple. Move from cash to assets. Not gambling, not speculation. Just converting paper money that loses value into real things that hold value. But escaping the savings trap is only the first step. Because even if you protect your savings, if your income doesn't rise with inflation, you're still trapped. You're still losing ground. So now we escape the income trap. If your income doesn't rise with inflation, you lose automatically. Here's the brutal math. Let's say you make $60,000 per year. Inflation is 5% per year. That means every year, just to maintain the same purchasing power, you need a $3,000 raise. But most employers give 2 to 3% raises. Maybe so every year, you're falling behind. Your salary number goes up, but what it actually buys goes down. After 10 years of 5% inflation and 2% raises, you lost $24,000 in purchasing power, and you didn't even realize it was happening. This is the income trap, and most people stay in it their entire lives. They work harder, they get promoted, their salary goes up, but their lifestyle never actually improves because inflation eats everything. So how do you escape? You build income streams that inflation can't kill. Move number 1. Develop digital skills with global demand. The economy is changing faster than it ever has. Jobs that existed 10 years ago are disappearing. Jobs that will exist in 10 years don't exist yet, but there are skills that will always be valuable. AI tools and automation companies need people who can use AI to 10x productivity. Video editing, every business needs content. Most can't make it themselves. Data analysis, understanding data, is the new literacy. Design, Figma, Canva, Adobe, visual communication is currency. Online consulting, sell your expertise directly, no middlemen. These skills let you work remotely, earn in dollars even if you live somewhere cheaper, and scale your income without scaling your time. And here's why this matters. For escaping the debt trap. When inflation hits, physical jobs get squeezed. Employers cut costs. Wages stagnate, but digital skills, you can raise your rates immediately. You're not tied to one employer's budget. You're selling value directly to the market. Move number 2. Build asset-based income. This is income that comes from your assets, not from your time. Index funds and dividend ETFs, something like SCHD, Schwab US, Dividend Equity ETF, pays around 3.5% in dividends. If you have $100,000 invested, that's $3,500 per year in income you didn't have to work for. And that income grows with inflation because companies raise prices and pass profits to shareholders. REITs, real estate investment trusts. You own a share of real estate that generates rent. You collect income every quarter. As rent rises with inflation, so does your income. Treasury bills and bond ladders. Right now, short-term treasury bills are yielding 4 to 5%. That's guaranteed income from the government. No risk of loss. Liquid. And when rates rise, you can reinvest at higher yields. Move number 3. Work in inflation-shielded careers. Some industries always grow. Some jobs always pay more because demand never stops. Healthcare, aging population, mandatory need. Technology, AI, cybersecurity, cloud, high demand, high pay. Energy, oil, gas, renewables, infrastructure is expensive, pays well, finance, money management never goes away. Defense, governments always spend on military. If you're early in your career or considering a change, these fields offer inflation protection built in. Here's the truth. You don't escape the debt trap by saving harder. You don't escape by working the same job and hoping for raises. You escape by building income that rises faster than inflation. Income from skills the market desperately needs. Income from assets that grow with the economy. Income from industries that never shrink. Do this, and inflation can't touch you. But even if your income is protected, if you keep that money in the wrong places, it's still vulnerable. Because the banking system itself is the weakest link in the entire debt trap. So now we escape the banking trap. The system depends on you keeping money in the worst place, your bank. Let me tell you what's happening right now that nobody's talking about. In 2023, Silicon Valley Bank collapsed. Signature Bank collapsed. First Republic collapsed. Over 99 regional banks in the United States are currently on the FDIC's problem list. They're not failing yet, but they're one crisis away. And here's what most people don't understand about fractional reserve banking. When you deposit $10,000 in your bank, the bank doesn't keep $10,000 in a vault with your name on it. They keep maybe $1,000, and they lend out the other $9,000. So when everyone tries to withdraw at once, a bank run, the money isn't there. It's gone. It's been lent to someone else. The FDIC insures $250,000 per depositor, per bank. But here's the reality. The FDIC has about $128 billion in its insurance fund. Total bank deposits in the U.S., $17.5 trillion. Do the math. If 1% of banks fail, the FDIC is overwhelmed. If there's a systemic crisis, another 2008, another Great Depression, your deposits are not safe. The insurance doesn't cover it. So how do you escape this? Move number 1. Split your funds across multiple banks. Never keep everything in one institution. If you have $200,000, don't put it all in one bank. Spread it. $250,000 at Bank 1. $250,000 at Bank 2. Now you're fully FDIC insured at each institution. And use Tier 1 banks with strong balance sheets. JP Morgan Chase, Bank of America, Wells Fargo. They're too big to fail. The government will bail them out before they collapse. I'm not saying that's right. I'm saying that's reality. Use it to your advantage. Move number 2. Keep money in safe custody accounts. Your bank account is an unsecured loan to the bank. You're a creditor. If they fail, you're last in line. Better options. Money market funds. These hold short-term treasuries and equity debt. They're not technically insured, but they're backed by the safest assets on earth. Vanguard, Fidelity, Schwab all offer money market funds yielding 4 to 5% right now. Treasury, direct accounts. Buy Treasury bills directly from the government at treasurydirect.gov. No bank, no middleman. Your money is owed by the U.S. government, not held by a fragile institution. Brokerage accounts with SIPC protection. SIPC insures up to $500,000 in securities. If you hold Treasury ETFs or money market funds in a brokerage account, you have more protection than a bank account. Move number 3. Replace banks with government instruments. Why earn 0.5% in a savings account when you can earn 4 to 5% in a Treasury bill with zero bank risk? Here's the move. Keep 3 to 6 months of expenses in a checking account for daily life. Move everything else into Treasury bills or money market funds. Treasury bills mature every 4 weeks, 3 months, 6 months. You choose when they mature. You get your money back plus interest, and you buy another one. You're earning more. You have zero bank risk, and you maintain liquidity. You listen carefully. Banks are the weakest link in the debt trap. They're over-leveraged. They're interconnected. And when one fails, others follow. You escape by reducing your dependency on them. You don't need to go off-grid. You don't need to bury gold in your backyard. You just need to move your money out of fragile banks and into safer instruments that pay you more anyway. Do this before the next crisis, because when it happens fast. But even if you protect your savings, build inflation-proof income, and avoid bank failures, there's still one trap that pulls people back in, the lifestyle trap. And it's the most dangerous one because it's invisible. Let me show you. Debt is not just financial, it's behavioral. Here's what happens to most people. They get a raise. They feel like they're making progress, so they upgrade their lifestyle. Bigger apartment, nicer car, better vacations, more subscriptions, and suddenly, even though they're earning more, they're not saving more. They're not building wealth. They're just spending more. This is called lifestyle inflation, and it's the trap that keeps high earners broke. Someone making $50,000 lives paycheck to paycheck. They get promoted. Now they make $80,000. But instead of investing the extra $30,000, they move to a $500 a month more expensive apartment, lease a luxury car, and add $200 a month in subscriptions. They're earning more, but they're still trapped. Because the debt trap isn't just external, it's internal. It asks the choices you make every single day that either move you toward freedom or back into bondage. Move number 1. Reduce recurring expenses. Here's what drains wealth silently. Subscriptions you don't use. Car payments on depreciating assets, credit card interest, financing, luxury items. Every recurring expense is a trap. Because once you add it, it's psychologically painful to remove it. You feel like you're going backward. The escape: audit every recurring expense. Cancel everything you don't actively use. Replace expensive subscriptions with cheaper alternatives. That $500 month in subscriptions, cutting it in half, frees up $3,000 a year. Over 10 years, at 7% returns, that's $41,000. You just bought yourself freedom by cutting things you didn't even value. Move number 2. Build a 12-month anti-trap cushion. Most people live with a 1 to 3 month emergency fund. That's not enough. Here's why. When recessions hit, unemployment lasts 6 to 12 months on average. If you only have 3 months of savings, you're forced to take the first job you can find, even if it pays less, even if it's a bad fit. You have no leverage. You're trapped. The escape: build a 12-month cushion. A full year of expenses in liquid savings. This gives you the freedom to wait for the right opportunity, to negotiate, to say no to bad deals. Freedom isn't about being rich. It's about having options. And options come from liquidity. Move number 3. Follow the 3-bucket model. Here's how to organize your money so you never fall back into the trap. Bucket 1. Survival money. Liquidity. This is your 12-month emergency fund. Cash or high-yield savings. You never touch it unless there's a genuine emergency. Bucket 2. Growth money investments. This is your index funds, your treasury bills, your dividend stocks. Money that grows with or faster than inflation. You don't touch this for 10+ years. Bucket 3. Freedom. Money skills. Business. Income growth. This is money you invest in yourself. Courses, certifications, starting a side business, building skills that increase your earning power. Most people only have bucket 1. They save for emergencies and hope it's enough. Wealthy people have all 3 buckets. They protect downside, build upside, and invest in income growth. Move number 4. Stop financing lifestyle finance assets. Here's the rule that separates people who escape from people who stay trapped. If it depreciates, pay cash. If it appreciates, finance it. Bad financing? Cars lose 20% value the moment you drive off the lot. Furniture, electronics, clothes, vacations, these things lose value. Financing them means you're paying interest on something worth less than you paid. Good financing? Real estate historically appreciates. Businesses generate cash flow. Education skills increase earning power. If you're going to borrow money, borrow it for things that make you money, not cost you money. Here's the truth. The lifestyle trap is the reason people stay poor even when they earn more. They escape financially but trap themselves behaviorally. You escape by making one decision. Assets grow. Lifestyle drains. Every dollar you spend on lifestyle is a dollar that can't work for you. Every dollar you invest in assets is a dollar that compounds into freedom. Choose your trap. Let's bring this all together. Your competitor showed you how the debt trap was built. For architects, 3 centuries. One system designed to keep you paying forever. But now you know the 4 escape routes. Escape number 1. The savings trap. Move from cash to assets. Tips: gold, index funds, treasury bills. Stop holding paper money that loses value. Start holding things that rise with inflation. Escape number 2. The income trap. Build income that inflation can't kill. Digital skills. Asset-based income. Careers in industries that always grow. Stop trading time for money. Start building income streams that scale. Escape number 3. The banking trap. Spread your deposits. Use Tier 1 banks. Move money into treasury bills and money market funds. Reduce dependency on fragile institutions before they fail. Escape number 4. The lifestyle trap cut. Recurring expenses. Build a 12-month cushion. Follow the 3-bucket model. Stop financing lifestyle. Start financing assets. Here's what this means. You may not be able to change the system. You may not be able to stop governments from borrowing $315 trillion. You may not be able to prevent the Federal Reserve from printing money forever, but you can absolutely escape it. You can protect your savings. You can build inflation-proof income. You can avoid the next banking crisis. And you can break free from the lifestyle trap that keeps everyone else stuck. The debt trap is real. It's structural. It's designed to extract wealth from you for your entire life. But the back doors are real too. And now you know where they are. If this video gave you the tools to survive 2026, to protect your money, and to break free from the system designed to trap you. Subscribe right now, because this is just the beginning. The system is collapsing faster than most people realize. And I'm going to show you exactly how to navigate what's coming next. Click subscribe, turn on notifications, and let's escape together.